it's not about the transaction. It's actually about the relationship building and the connection that you're building, because those are the people you want standing next to and celebrating with you. But if it doesn't go well, you also want those people to feel bought into you as a person to help pull you out of the trenches when you need it. What we're looking for, though, at an earlier stage than that is we're actually really focused on founder solution fit. Is actually a better leading indicator of traction and success. A good founder with a good solution is somebody who's integrated with that industry and understands that industry, but also actually understands the problems and knows where the actual demand of that process is in order to create the buyer life cycle.
Welcome to the Raise and Exit podcast, where we are able to speak with former founders, current founders, founders turned venture capitalists, private equity owners, whoever it may be, on what it really takes to be able to raise and exit a business. And on today's podcast, we go and have an exceptional guest, Sebastian Harris, who's going to be giving you a pathway that might not be the most conventional to becoming a multi-time entrepreneur and now fund manager. So on that note, Sebastian, please be introducing yourself, give a little bit about your background. I'm mostly curious as to how somebody who started in nonprofits is all of a sudden a serial entrepreneur and now is involved with multiple funds. So on that note, please introduce us more to the listeners and viewers today.
Yeah, hey everyone. Thank you again for having me. So my name's Sebastian, and I grew up in a small little country in the middle of nowhere called New Zealand. Moved to the U.S. about 10 years ago. Followed an American girl and kind of didn't look back. And then here we are in the United States. But had a real passion for serving people across various different verticals. It's always been something that's really been a part of who I am. Is like a real service-oriented kind of person, wanting to make an impact in the world as much as possible. And so that led me into the nonprofit space, where I ended up working in a couple of organizations focused on the Middle East and specifically how to create more peaceful dynamics inside the Middle East. And one of those organizations put on the inaugural economic forum that we were a part of between Israelis and Palestinians. So this is back in 2019, so well before the current kind of conflict area that we're in at the moment. The main purpose of that event was to bring Palestinians and Israelis together as co-founders, as equals of tech startups and companies, and support the infrastructure for them to both kind of come together under this guise of like, hey, if we all actually just work together and seek prosperity, then maybe we can get to a more peaceful coexistence. And so for me, that was a big light bulb moment where the transformational power of business to actually shift culturally diverse or culturally problematic situations was actually more easily solved in business than it was solved in the nonprofit space. Nonprofit's great for having conversations, humanitarian aid, all that kind of stuff, which is really critical and important. But like, what if you could attract significant for-profit capital into business dynamics that actually could also create that dynamic and at the same time create prosperity for the culture and society as a whole and start to blossom an economy at scale? And so that was the moment that kind of shifted me into the business world, and have had several businesses that we've run and operated, a couple companies internationally. One was in the US called Public Square, which is a values-based e-commerce platform turned fintech marketplace. Doing really well. Inception to IPO in 2.5 years. Took an exit after the IPO and then started focusing on several other things, which led us to the point now where we're in the middle of launching our first venture fund. With a slightly different process, financial model to help us create more liquidity for founders and investors at the same time. So it's been a fun journey of problem solving on the business side of things.
It's no accident that you're on this podcast, Sebastian, because that is literally the thesis of this, right? We're here to really go and provide that. And I really found it fascinating and kind of getting ready for this around how you're talking about like a win-win-win approach to how you want to work with founders and companies and kind of the ecosystem that facilitates. Because what it really reminds me of is years ago I did a lot of work with kind of organizations and development banks, and they had a real focus on triple bottom line. And so going and seeing what you're going and talking about, a win-win-win, that to me is kind of like the business side of it versus the kind of like the more, I think, aspirational or romanticized side that was there on development banks. So tell me a bit more of what win-win-win looks like, or how you envision it coming to life out of the fund that you've launched.
Yeah, it's a great question. I think part of the motivation for us in this was like, how do we not only make the investors win, number one, number two, how do we make the founders win at the both ends of that scale, that continuum, but then we win in the process as well. That's what really win-win-win looks like for us. Investors winning, founders winning, and us winning as a fund.
Yeah.
And so if we can make that happen, then the macroeconomics and all of that works out, then the reality is we're creating a win-win-win situation. So from a financial perspective, that's the key, and so we kind of set out to solve that problem. And obviously the number one problem in venture from an investment perspective is liquidity. How does liquidity actually get solved for investors, especially if you're just, venture's kind of got this bad rap of being high risk gambling, with several, because the risk is like, for an investor, is that you can put the money in and then none of the portfolio companies work out. And so what mitigation processes are there? So what we've built is a hybrid model, where we're using structured finance and cash flowing real estate as a tier one strategy. So we deploy all our capital into that strategy as a hedging component.
Oh, interesting.
And then the interest from that, then we deploy back into venture capital. And so from that perspective gives us several wins. Number one, investors are able to take liquidity out of the fund from very early in the fund life cycle, number one. So that helps solve that problem. The second problem it solves is more of a founder dynamic, which is, of course, there's a fiduciary responsibility for the firm to provide returns to the investors. But usually how that happens in venture is because the venture is the only mechanism to get returns, the cycle of pressure that gets put then down onto the founder often creates dynamics which actually don't help the founder perform better, as opposed to if that pressure is alleviated a little bit, then we get to come alongside the founder a little bit more intentionally to help solve some of the problems and get them to scale. And so that's why they call it an investment thesis, right? It's a thesis to say, like, if we can take some of that pressure off, then founders will have more ability to perform and align to market trends and get to venture scale is the idea.
That's really, really great, because it's what you're kind of telling me, if I'm reading this right, is from the other side, you're able to understand the pros and the cons of the fundraising ecosystem differently. So give me something that you would go and tell from the lens of now having been a founder who raised, exited, and is now investing back in. What is something that a founder would want to know of what it is like for the investor? Like, what is something they want to keep in mind that they might not realize until they've gotten to the state that you're in, which is cutting checks for people? So what's something that they should be keeping in mind that maybe is impairing them right now if they don't?
I think what's really interesting about the whole fundraising dynamic is that it feels oftentimes it's just very transactional, right? Like we think about it as like we're going out to find money and the investors have the money and the founders don't have the money. And so we're just it's a matchmaking. It's like dating,
Yeah. I
think, and the reality of fundraising is a very relational process. It's actually a lot more about the relational dynamics between the investor and the founder that accelerates, is their momentum here. And oftentimes we find, and this is part of our thesis, is impact-driven companies and mission-aligned companies. And so we're looking for, not just the founders that have a great deal, but like who are the founders out there that have brought impact into the ecosystem of their venture and how they're doing that. And I think when you start having that conversation, the macro trends of mission or impact-minded investing is actually starting to grow. It's not decreasing. It's because like intrinsically we're all human. And so I think that's really my answer to the question. Like in the process, like it's not about the transaction. It's actually about the relationship building and the connection that you're building. Because at the end of the day, if it goes really well, those are the people you want standing next to and celebrating with you. But if it doesn't go well, you also want those people to feel bought into you as a person, to help pull you out of the trenches when you need it. That kind of partnership, investor-founder partnership, is actually really critical to success, I think, because you can attach advice and momentum and all the kinds of other intangible things other than the capital into the dynamic. So I think that's really important part of the puzzle, is the actual humanity of business transactions is critical.
I want to build on that, actually, because a lot of my conversations that I've had with investors, with founders, all the way from like pre-seed, seed, venture, all the way to growth equity, to like private equity, private debt, etc., is I find that there's almost like an inverse relationship to that humanity aspect of it, right? If you look at like a pre-seed or a first check investor or fund, they're usually they're almost like, I would almost say like a fractional co-founder, right? And then the further you get away from that stage, you get into the more mature state of the business, the more it just becomes called like the tangible abstraction of money, right? Here you go. Here's some money. Go and make it work for me, because you're going to be able to turn this money into more money better than if I gave it to somebody else. So how do you translate through that, especially as you've gone through starting companies and having an IPO? Like, that is an investor release that is completely different. So tell me a bit more about that aspect of it. How do you plan for that? Can you plan for that?
That's a good question. I think the answer is yes. I think you can plan for it, but it depends on what kind of company you're trying to build. I think, with the increasing amount of artificial intelligence coming into the tech space and the companies at large, the amount of work that's going to be done by actual humans is actually going to be a lot more relational work, which also means that the artificial intelligence is giving way for a lot smaller teams and a lot smaller, company footprints, because you can actually get so much further with artificial intelligence. Now, that's a good thing in my mind, especially as an investor. It's because now we're looking for companies who can actually operate incredibly, 10 years ago would have been considered incredibly lean, but now is actually really exciting. And means that there's a lot less need for OPEX and CAPEX on the table in order to get to venture scale, because revenue can be explosively created while focusing on the humans on the right things and artificial intelligence on the right things. And so, in that cross partnership, I think you can start to plan and start to build for what does cultural development of the company look like? Because that's really it's a story arc, just like the marketing arc, right? It's the company culture actually driving forward, and are we going to continue to be a relationally minded company, or are we just going to be about the transaction?
So, this is so good, Sebastian, because where this weaves to me is, if we look historically, right, the role of venture was, I have an idea, I want to be able to kind of create a product, be able to stress test it, get to the product market fit. And to be able to do that, it looks like this. Boom, we're in the negative for a while. In fact, go and give me another couple of rounds, we're in the negative. And then we're going to go and find that fit. It's going to turn into cash. We're going to get to profitability. We're going to get to profitable growth. We're going to start paying back the bleed from the promise, right? Because the venture doesn't stay there to go and get the money repaid from operations. They get it from exiting. So it changed the dynamic, I find, also for valuation. There's so many stories, sometimes horror stories, of founders being diluted into the low single digits, even though they're the ones who are kind of leading it. Do you think that this new AI-enabled age is going to change the balance of ownership between founders and investors? Give me your thoughts on that, and how are you applying that to how you kind of check yourself?
Yeah, I think that's a really insightful question, because I think it's happening right now. And because you can get further with less humans, there's less humans to distribute equity to, especially at that early co-founding stage. And so, single founder companies are becoming more and more common, where I know YC has the two co-founder ideal, which is great, and I still think that's really valuable, because you can cross pollinate and partner. But even within that founding group, we're getting to like see some seed rounds and even early A rounds where the founding group still has like 80% of the company, which 10 years ago was kind of unheard of. By the time you get to the A round, you're lucky if you've got 60% in your founding group.
Yeah.
That would have been a miracle, based on the amount of rounds and how much the length of time to get to product market fit.
Yeah.
What we're looking for, though, at an earlier stage than that is we're actually really focused on founder solution fit, because I think founder solution and fit is actually a better leading indicator of traction and success than product market fit in terms of valuation growth. Because that partnership between the founder and the solution, and especially in impact-minded businesses, is really critical for the demonstration of, can this person actually get more traction and demonstrate traction through letters of intent and growth mechanisms and wait lists and things like that. Like, do they have the ability to really scale that? Or is it more dependent upon, just they have a finance background and so they know they can attract capital because they're connected? That's okay, but is there a founder solution fit? Because those are the actual companies that really matter. Take Facebook as a great example. Zuckerberg created Facebook because he was at Harvard trying to look at other people's faces, and the dynamic is very, very founder solution fit, and that's part of what created the exponential growth in my mind.
So want to build on that founder solution side, because I've had the privilege in my career and what we do professionally in also going and what I call demand solution or demand offer fit. Is there enough demand at that scale or at that level of the solution for what you're offering at your current level of comprehensiveness, right? And if you're familiar with Jeffrey Moore's work, right, you go from, there's a percentage of the market that is early, like innovators, like they're willing to go and, innovate alongside with you. And then you get to the market where like, listen, like I'm only going to switch to this new solution because the old stuff is, Microsoft's no longer supporting it. I'm going to get the latest version of the software, right? Because I have to. So how do you solve for the founder solution fit being scalable to when it actually becomes around market demand and sufficient level of full serve solution? Give me your thoughts on that, please.
I think the same way that you're talking about. The initial stage for me is all about founder solution fit, but the solution has to have demand side economics as the forefront of that solution. Like, it's not a true solution unless there's demand, because supply side thinking has robbed us blind, and especially in the venture capital space. Like, as VCs, we've poured so much money into supply side ideas, and then trying to figure out like whose problem does this solve. Like, that's never the right place to start. A good founder with a good solution is somebody who's integrated with that industry and understands that industry, but also actually understands the problems and knows where the actual demand of that process is in order to create the buyer life cycle, and take people along the buyer's journey, because they're actually meeting people at the right place in that journey. Yeah. So I think, that's really the critical piece of that for me. Like we're not in an economy anymore where supply side ideas are going to get a lot of traction, because they end up going nowhere. I mean, in my opinion, there's a lot of fluff in the AI world right now.
Oh, you and me both on that one. And as a sector, I would say right now it's, by my number crunching, about 170% overvalued.
Yeah.
Right.
Yeah.
Like if you look at the fundamentals that is there, and have just recently seen some great data of like, look, this is the golden age of cheap Uber AI. Right. AI is cheaper than its standing operating cost. If you look at the unit economics for any of the providers that is there right now, like, ChatGPT can't make money at $200 a month. They're clearly going to have to go and raise that to a whole new level. And I think that, to me, is the types of things that I think founders and investors kind of need to anticipate, which is how long does the current run live, right? It's to the founder solution fit, to when does it become to a critical mass of demand that's there. So I think that's really insightful. I want to ask you, because we've kind of been talking about like what we agree or disagree with in the market by association here as well. What is a contrarian take that you would recommend founders to consider when it comes to raising capital today?
I think you actually have to really really need it. And 9 times out of 10, and maybe 99% of the time, even there's a way to solve a problem that doesn't actually require more capital. Is my perspective. I think the companies that we get excited about the most are the ones who've like extended their runway extravagantly through bootstrapping and leveraging prototyping to validate their idea, validate solution, extensive consumer testing to see and validate whether things are actually going. Like, so for me, like all capital is growth capital. Like we sort of say, like early stage capital is just like the seed to like get you to go and figure it out. Like that's what we used to seed rounds were. The reality is now even seed rounds are growth capital. It's about scaling the marketing for the idea, less with people and more with automation. And so, I think the emerging age right now is like keep bootstrapping as much as you can, because some of these solutions are actually, it's time for them to happen. And then based on the traction and the revenue that you've built, then let's talk about growth capital and how we can come behind to get you to the next level, as opposed to a blank check basically to say, go figure it out. Like,
I love how you anticipated. I love how you anticipated my follow-up question, Sebastian, which is, where is the mix going? And you just essentially said it, right? It is around growth. It's about going and being foundable with your solution that is there, and going and giving sufficient proof points or evidence to be able to go and kind of make that happen. So that's been really, really great. Sebastian, I so appreciate just kind of like the perspective that you brought. You're launching an early stage fund, so naturally you want all 8 billion plus people in the world to go and apply for a check, right? So maybe let's zone it down a little bit. What type of a founder would want to approach you and your fund? What are they working on? What is their solution that they are the founder solution fit for, that you're like, I like this team, or I like this founder, I'm willing to go and join the ride with cutting a check?
Good question. We're looking for impact-driven entrepreneurs, entrepreneurs who actually want to make a difference in the world at large, but are willing to kind of integrate their business model to be able to solve that problem. So it doesn't mean, they're missionally motivated and they're giving a bunch of money off the top over here. It's more like, how does the actual business model shift culture, take us in a better direction, provide technology that solves people's problems and help us move forward as a society. Those are what we're looking for. We're looking at early stage, mostly seed and Series A, trying to focus pretty broadly on impact-driven entrepreneurs. We're a faith-based fund as well, so we're looking specifically at Christian founders. Inside that, we're looking at creator economy, fintech, med devices, med software, and infrastructure solutions. So pretty broad. So we'll see how it goes. But those are the buckets.
I love it. And I think that allows people to self-qualify themselves very quickly to save your time and their own at reaching out to you. So I'll go and put one last thing, and it just has to do with the fact that you're a Kiwi. There's this fun story that I have working with folks from Australia and New Zealand, which is, hey, welcome to the next day. So now that you're stateside, is tomorrow better or is today better? Which is it better to be there when the day starts, or is it better to be there when the day ends?
Yeah, it's a good question, but like that question makes me reminded there was a bar in my local hometown, and on the book above the door it said "free beer tomorrow" above the door, and so that kind of sums up my thinking about it. It might be free beer tomorrow, but tomorrow it's going to be tomorrow.
That's exactly it. I love it. I love it. Sebastian, thank you so much for joining us. It has been such a pleasure to kind of get your perspective. And really, for everybody listening, go and figure out what is the win-win-win that you're able to go and have. Thank you.
Thanks.
Reflecting on my interview with Sebastian for the podcast, I thought it was really, really interesting how somebody with such a diverse background has gone through being a founder and then become an investor, and then being able to really go and look at cause-based investments. And what I really, really liked about him is how really at or ahead of the curve he was in terms of the thinking, in terms of like, where is the money actually going in terms of your business? You're looking for lean, automated, high-value ideas. It's about going and seeing whether you can go and get your company to profitability and value for a relatively low amount of capital, not just going and taking a look at the maximum return. Another aspect of going and having Sebastian on our show that I thought was really interesting is that there are founders that are out there wanting to go and have meaningful impacts that aren't chasing the $1 billion, $10 billion, $100 billion company. And there are people who are willing to go and make the investments into building really, really good companies. And I think this is critical for people to go and take a look at is what is it that you're looking for, and what are people going and looking for from you? One of the key dynamics that I espouse throughout the podcast series and professionally is that your valuation is a combination of the business that you're in, the appetite for investments in your space, and then in a minority role, how your own individual business is actually performing, which might be controversial. But I think what Sebastian pointed to is that there's people who want to go and make sure that outcomes happen in the marketplace. And to be able to achieve those outcomes, it's not about who can burn the cash the fastest, but it's about who can go and drive that value. So going back to my theme of sometimes non-flamboyant or not extravagant venture capital founders in terms of funds, go and find people that you like the dynamic with. You might be the energetic one. Go and have a calm person that's on the other side. You might want to go and have a hyper industry specialist who's there by your side. Also make sure that you have somebody with a diversity of background and thinking. And ultimately, I think it's very critical for you to go and see what are you both trying to achieve? What's the run rate that you're willing to go and operate under? Will you be put under pressure to go and achieve results financially faster than you actually think you might be able to get to them? Or it might not be your number one priority. So there's a huge diversity of funds out there. There's a lot of venture capitalists out there. And I think as you go and look and find people like Sebastian Harris, you want to go and make sure that you really interview them deeply. Again, look for a fit, not just money. And that's kind of my guidance from this episode with Sebastian today. Cheers.